Forex is a combination of the world's foreign exchange and involves changing one currency to another to generate a profit. In the foreign exchange market, the currency is traded in Paris. So, when you buy a currency, you sell another at the same time. But how do traders generate a profit? Well, the value of currencies fluctuates based on different economic, political, or economical factors. A forex trader keeps a close eye on these factors, predicts the related effect on the value of a currency to buy one whose value is likely to increase and sell the one whose value is likely to decrease. Let us understand this by an example. Suppose you are traveling to the US from Australia and have 500 Australian dollars with you. Since you would need US dollars in America, you converted 500 Australian dollars to US dollars and by the current exchange rate received 320 US dollars. Now, after a few days you travelled back and assuming you never spent anything, you converted those 320 US dollars back to Australian dollars and got 520 Australian dollars instead of 500 Australian dollars. The additional 20 Australian dollars is due to the fluctuation of currencies, and this is exactly how foreign exchange works. But this process of travelling to other countries and coming back without spending anything is not logical. Forex currency trading is done using a computer and internet connection. You buy and sell by clicking just a few buttons. There are dedicated Forex brokers as well offering related services. Forex does not have a physical location as it is a global decentralized market traded 24 hours a day and 5 days a week. No other market in the world trades more, and so you have a lot of opportunities to trade and earn.